Hello there, Monday, April the 24th, and quickly want to apologize for the quality of last week's video. Definitely was not where I want it to be, but as I muddle through the technical issues and all the little tweaks and quirks with the recording of this, hopefully it's slowly improving. This week, I thought I'd change up the backdrop a little bit. Ryan's birthday is this week, and he turns 30, so a lot of years have passed since this little smiling Buddha joined us, but it's all been great. And I feel a little older, obviously, this week, or I'll feel a little older later this week when the celebration happens. But anyhow, news on interest rates and the mortgage world. Not much in the happenings of rates. Bond yields, which I harp on each week, have started this week at about 3.1, and I believe we're at 3.2 last week. So they're still hovering around that 3% range on the 5-year term. The Bank of Canada does not meet again until early June, so we've got some time to watch how things move over the next 6 weeks. But the inflationary report came out for March last week, and it's on track to where the powers that be wanted to go, sitting at about 4.2 today. We get another report in mid-May, which will be April's, and we'll see how things go. I think it is important to note that it was a year ago this month that the rates started to lift, and the cost of everything started to spike somewhat as well. So having a 4.2 inflationary rate over last March is food for thought. But again, there's so much minutia in inflationary measures and what have you, and how they calculate and formulate, that I won't get into it. But I think that the key number that we need to watch is whatever they report. So 4.2 is a positive one. When we get into that 3% range, if we do over the coming months, then that'll be right on track for the 3% summer and 2% by the end of the year, which in that time frame is when we expect to see some softening in the overnight rate, which really supports the variable rate and lines of credit, what have you. But fixed rates should sort of react to that same pressure. So the strategy for us, as mentioned a week or two ago, is a 3-year fixed right now in terms of where it's at, where it's priced, and how it matures, hopefully in that next cycle of bottoming. Again, no crystal ball, but that's what the bet is right now, where we're going to go. So if we can bottom out in the next 2 to 3 years, then the 3-year rate is probably ideal in terms of maturity and renewal. And hopefully we will continue to watch and report on that as we go forward. One thing I wanted to ask, and just drop us an email response to this video, but I've been doing this on Monday mornings, and it was with the intent of starting your week with some content to work with. But a lot of the reports, inflation report, I believe it was last Tuesday, Bank of Canada reports on a Wednesday. I'm just curious what days make most sense to you. I can do this whenever is most suitable, but again, my initial start with this was to do it on a Monday to start your week. But if it makes more sense for Wednesday or Tuesday or even Sunday for that matter, just let me know, and we can adjust that as need be. And with that, I will wish you a wonderful week, and we'll look forward to catching up again next week. Bye for now.